Hello, this is Todd Hubbs, agricultural economist at the University of Illinois. Today I'm talking about my weekly outlook from November 18, 2019, soybean crush prospects. I'm going to dig into what I think soybean crush might be for the 1920 marketing year. We saw a pretty strong NOPA crush report last Friday, and that bodes well for the current USDA projections for crush, and I'm going to dig into the numbers a little bit today. In this graph, I'm showing monthly soybean crush reported by the USDA and Decatur gross crush margin, which is just basically meal value, oil value, less soybean prices paid at Decatur. And as you can see, we saw a really strong crush, and that last bar is a projection of around 185 million bushels due to the strong NOPA crush report in October of about 175.4 million bushels. It's a real recovery from what we saw in September, which led the USDA to lower their crush prospects by 15 million bushels to 2.105 billion bushels for the marketing year. Barring any kind of pickup in trade where we see a trade deal and China starting to buy soybeans at a rapid pace, I think we're on pace to hit USDA's current projection with stronger soil oil prices in particular, and we've seen a recovery in soybean meal prices. So while the crush margin looks lower than it was back when we were really crushing strong, it's still a pretty positive crush margin, and I'm pretty optimistic that crush under current market conditions will meet the USDA projection. So I'm going to talk about soybean meal and soybean oil in a little more detail. Right here I'm presenting monthly U.S. soybean meal use, so I've got it split between domestic use and exports. I think I'm pretty optimistic on domestic use for soybean meal this marketing year. I think you could see livestock production up quite a bit, particularly with the African swine fever and China recently opening up their market to poultry imports. In production, pork and poultry could in particular be very strong in the near term and into early 2020, and I think soybean meal use will reflect that case. Exports, we're down a little bit thus far this marketing year. We're only 6 weeks in. It's important to remember the marketing year is October through September in meal and oil. And we're sitting down about 8% below the 5-year average on total commitments. Now, while accumulated exports are up, exports outstanding sales are down a bit, mainly to EU, Japan, and Vietnam. That's where we've seen some of the sales not materialize thus far this marketing year. And it's still early. But I think soybean meal in general at the current price levels, just a little over $300 a ton, we'll continue to see, if soybean prices are relatively low, good crush margins for crushers and continued production of soybean meal moving into domestic and into foreign markets. Similar to soybean meal, what you're seeing here is a monthly soybean oil use chart from for the U.S., and I split it into 3 categories: biodiesel, food and other, and exports. And as you can see, exports have sort of weakened at the close of last marketing year, but we're off to a relatively strong start this marketing year for soybean oil exports, and I think that might continue. The African swine fever, lower crush in China has raised prices for particular palm oil in the Asian markets, and I think soybean oil, as it's gone over 30.5 cents a pound, will continue to show strength because world stocks for vegetable oil are down about 0.7% from last market year under current projections. So I think you might see exports get a little bit stronger as we move through. I think domestic use for food and other will still be strong due to the high prices for a lot of vegetable oil in the world right now. The place where I'm a little bit concerned for soybean oil use is biodiesel. Currently, the USDA has about 8.5 billion, and I think that might be a little bit optimistic. We still have issues with the biodiesel credit that Washington can't seem to figure out, and there's been reports of some plants closing over the last few months, so they might be a little bit optimistic at 8.5 billion. And we'll see as we move through the marketing year, but regardless, I think soybean oil use will hold up and be an important part of the total crush margin. Soybean crush for the 1920 marketing year is on pace to hit the USDA projection, and I think it will. We've seen some positive demand factors for both soybean meal and soybean oil that I think will keep crush margins quite strong, particularly over the near term. If a trade impasse and a lack of resolution of trade deal with China comes into place, soybean crush will still be the dominant use for U.S. soybeans. Now, some kind of resolution to the trade deal that runs up soybean prices and takes some soybeans away from crush processors may hurt soybean crush, but will pick up that demand in the export market. So crush is still poised to meet the current USDA projection, and I expect that to occur. Well, I'd like to thank you for your time. You can find my weekly outlook and daily analysis of issues related to Corn Belt farm economics at farm.daily.illinois.edu. I look forward to seeing you around the state of Illinois.